I think we are in a very, very heightened period of high valuations for equities. We are in high valuations for real estate. We are in tight spreads, meaning the amount you get paid over a U.S. Treasury for its equivalent maturity in investment grade and high yield are quite tight, meaning you're not getting paid a lot. If they keep rates where they are, they have the sense of choking off the economy, and you clearly have a stressed consumer and unemployment growing, and clearly all the signs of recession.
Equity markets hit new all-time highs this week, with the S&P 500 closing at just over 6,200 points. On Thursday, the NASDAQ at over 20,000 points. And just today, Trump announced new tariffs on Canada. Earlier the week, he announced tariffs on copper and pharmaceuticals. So it seems like the trade war is coming back, although the equity markets are kind of ignoring that. We'll talk about how the bond markets are reacting as well with our next guest, David Sherman, founder and CIO of CrossingBridge Advisors, also adjunct professor at the NYU Stern Business School. Welcome to the show, David. Good to host you. Honored to have you on the program.
Great. You spoke so quickly, David, that I thought you said I was a junk professor at NYU, and I do specialize in high yield debt or junk bonds. So there's some parallel to that.
No, I'm sure your ratings on Rate My Profs are very high, so definitely not junk in that sense. Although we could talk about junk bonds today as well. I think my first question to you is actually how the corporate bond market is reacting, if any, reaction at all to the tariffs announced this week. I mentioned and referenced copper being tariffed, 50% pharmaceuticals. Trump floated the idea of 200% tariffs on drug imports, and just earlier last night, 35% tariffs on Canadian imports. That is aside from any specific duties on specific products, so it could even be higher. Trump threatened that he could up the 35% number if Canada retaliates. So the equity markets today, flattish, so not really responding to this. Any response from the bond markets? Are bond markets pricing in an escalation? What do you think?
I don't really know. I mean, I can go on my Bloomberg here, and it looks like treasuries have sold off a little bit, meaning rates are higher.
Yeah.
It looks like if I go to my little Bloomberg here, it's coming up. Looks like change in value is negative for LQD, which is investment grade, and in high yield, that's the investment grade index, ETF, passive ETF. High yield's kind of mixed. Most of it looks like, again, spreads have widened a little bit, but not a lot. So, quite frankly, this is just more of the same. Different days, same story.
The 30-year is up 1.87%. 10-year as well is slightly up to 4.41%. Just give us a summary of your outlook for yields going forward into the second half of the year, David. Are we approaching near 5% or are we coming down?
So I'm not an economist or an interest rate speculator. I think that if you're an active manager in fixed income markets, particularly where it's credit related, you're a value investor, and the value will earn out. And I'm relatively not interested in positioning my portfolio for day-to-day, month-to-month, or quarter-to-quarter movements. I do have some views, which I won't answer your question. But look, I don't think anyone knows, right? Mm-hmm. I think the greatest prognosticators have been wrong most of the time. So we choose not to do that. We choose to make our money by actually fundamentally investing. And answer your question, I'm in the camp that the Fed's in a very, very difficult place. They lower rates, they have inflation problems, and if they keep rates where they are, they have the sense of choking off the economy, and you clearly have a stressed consumer and unemployment growing, and clearly all the signs of recession. The yield curve is normalized for several months, I think 7 or 8 or 9 now. Under that kind of normalization, after we went through, it's typically a sign that you either have entered into a recession or you're about ready to enter a recession. We definitely had some negative growth. Whether we can sidestep a recession or we're going into recession, I think the jury's out. And whether we have stagflation or not, I think the jury's out. I think that there's real lack of political will to do the right thing regarding physical constraints. And I think there should be term premiums. So I would say I am definitely in a steep yield curve camp, and I would actually probably be that short rates are going to come down. And what I don't know is, are short rates coming down from here, and long-term rates are going to stay the same or come down a little bit, or are the long-term and middle part of the curve going to stay where they are or go up, and short rates are coming down? But I'm into a steeper yield curve, and I haven't decided exactly where the middle or the long end is. But I don't really think you're being paid to be out on duration.
I think that was a great answer to my question. I think you're being very modest, David. So the steepening of the yield curve, what does that mean for a credit investor? How usually should one position himself if the yield curve is steepening?
Again, the fixed income market is so broad. You have floating, you have fixed, you have converts, you have straight bonds, you have sinking fund bonds, you have mortgage prepayment bonds. The fixing market is so broad. I don't think there's a one strategy fits all. Um, Look, at the end of the day, I think we are in a very, very heightened period of high valuations for equities. We are in high valuations for real estate. I mean, home prices are definitely over the top. We are in tight spreads, meaning the amount you get paid over a US Treasury for its equivalent maturity in investment grade and high yield are quite tight, meaning you're not getting paid a lot. I think that what you should be doing is looking at finding out where you're being compensated for the risk, understanding what your time horizon to lock up your money is for that risk, and where you get paid. So the areas of interest are off the beaten path asset-backed securities such as tax lien, where people have not paid their property taxes. The municipalities have sold off the tax receivables, and people have securitized it to go collect. Those are high quality assets because most people don't want to lose their home or their land. And if you have a good underwriter, you know what you're doing. And if you can be at the top of the capital structure of a securitized product with a relatively low duration, I think that makes sense. You're getting paid 175 to 200 off the curve for a 3-year maturity on AA credit. That's pretty good. So you're getting paid, take the 2 or 3 year part of the curve. So today, if you wanted to look at the curve, we would say, I'm just pulling up on Bloomberg just because I don't know these numbers off the top of my head. It's taking a little while to do it because I can't operate my Bloomberg correctly. Okay, so today, you have, let's say, I don't think this is the most attractive part of the curve. In fact, it's probably one of the richest parts. But let's take the 2-year, which is at 389. You're earning, call it 4.5 to 4.65 in yield. So a pretty big spread off that for a AA or single A credit. It's securitized, but you're giving up liquidity and you have a complicated security. That's on the investment grade side. In high yield, I think you're looking for things where there's a lot of potential events that are positive in nature, things that people don't necessarily understand. A great example would be Bally's Fitness secured debt, which also I think the stock might be very interesting for those who follow the stock, where their security is a restricted group of casinos, and the company takes the successful cash flow from those casinos and diverts it to new ventures. So if you're in the unsecured, not as good. And the company just recently announced that they're selling one of their assets or merging into another entity. So they're going to raise a bunch of money and they're going to most likely refinance out all this paper. So you have something where the bonds are going to come out before maturity, and you're buying them in below their face amount, and you're getting a good yield. The deal doesn't go through, you're still getting a piece of paper that's money good with very, very high yields. So I think, you have to, every credit as you go down when you want more return, it's like stocks. Everything's a story. You have to understand the story.
Have you noticed any changes in corporate spreads this year that may portend economic contraction or expansion? In other words, has this been an accurate leading indicator, at least for this year?
No idea. I think what's happened is spreads have tightened because people have a lot of money on the sidelines. They want yield. They got excited about 4.5% and 5% yields, where things were, and there's just limited supply. I mean, I personally like I think you're still being paid for floating rate securities because the curve's so steep on the front end, and the forward rates have to come down so much.
You mentioned the yield curve earlier in regards to predicting economic recession. So here's the 10-year minus 2-year from the St. Louis Fed. Not we're not going to look at this period for now, but just taking a look at prior periods, whenever the yield curve has inverted in the past and then reverted back to positive territory, that's when you get the gray bars, which are Enberg designated recession areas. Can you just explain from an economic theory perspective why it is that the bond market, at least the yield curve, has been pretty accurate in predicting recessions based on this pattern?
Actually, it hasn't been that accurate. I think there's a
Okay.
view that the 210 has been a very, very accurate indicator. Um, I think that the facts might meet the test, but there's been plenty of periods where you have elevated 2 to 10 where you've had
Mhm.
no recession, right? You can look on your own graph and see easily plenty of sustained periods where you have the 210 issue where there was no recession. Even the SOM index, SOHM, which has been a much better predictor of recessions. And the author of this has said, it's not as reliable as one thinks. Everyone's looking for the golden chalice or the solution to age. And to me, these are great technical tools to help frame a discussion, but they're not the end all and be all.
But can you just explain why? Okay, so yes, you're right. I mean, not every single reinversion has led to a recession, but let's just take the ones that have, for example. Why is it that the long end of the curve tends to steepen right at the onset of a contraction? I think,
I just don't think of it that way. So,
okay,
I mean, I understand what you're saying. Um, and by the way, it's not really the long end that's steepening in this case. That it's
it could
right.
be it
You're
could be the
doing
2 year falling. Yeah,
no, but the concept is you have an inverted yield curve, correct?
right.
Right. So the question is, why do you have an inverted yield curve, right? And you have an inverted yield curve, right, for many different reasons. And I think this is a very good tool to think about what's going in the economy. But the 2008 10 period yield curve inversion was extremely different than the sort of you know uh 90. I mean, I think I would say the 92 period, right? So I appreciate where you're headed. Again, I'm not a macro uh, top down or macro forecaster or macro strategist. I'm a bottom up investor that uses the tools of macro to make
Hmm.
money. In our career, we think the way to do this is, the way you make money is you protect capital first and foremost, and then you make selective, smart decisions, knowing you're going to make mistakes. But I think people spend a lot of time of, oh, is the Fed going to raise rates? Are they going to lower rates? Or what happens if it moves a quarter point? Truthfully, if interest rates stayed where they are today, the Fed fund
Hmm.
rate stayed here today. They don't move, they don't go down. Is it really contracting the economy? And if they drop rates 100 basis points, are you really making an economy healthier, or are you just increasing asset values and speculation? In other words, I'm not sure Fed fund rates are at a price today that they're choking off capital investment and they're choking off the economy. I think rates can be a little bit like a drug, right? You can bring them down so low to stimulate the economy, but we know negative rates, which had Europe happen, didn't stimulate the economy for a long time. I think there's a period where rates are really a problem.
Okay.
And I think where on the curve is a problem,
Well, let's
right?
talk about your
And
funds and
by the
your
way, what
yeah.
this is really about is the conflict between employment, dollar stabilization, and inflation. And I assure you, if the Fed or the government gets its way and they lower rates, and I think they're going to lower rates, I think rates are definitely coming lower, and I think it will definitely ease the depth
Hmm.
of a slowdown. Okay. But let's be clear. It also, you have to think about all the other factors. So, what's likely to happen is dollar devaluation. That's what's likely to happen. And you can spend all the time you want about whether rates should go up or higher. I'm convinced the dollar is going to continue to devalue. And that's really the bigger picture. And I think the other bigger picture is, are we going to have a Fed that's going to be able to remain independent? Those are really two big macro pictures that I think have a much more important long-term effect than whether the Fed drops rates 100 basis points over the next 12 months.
Wait, sorry. Why would the Fed not be independent anymore?
Because there is not an alignment of interest today.
Mm-hmm.
What the executive branch would like to see, what the Treasury branch, as part of the executive branch, would like to see, and what the current policy is. Right now, you have President Trump, who believes the Fed is behind the curve, and they probably are. I mean, I'm not arguing that he's wrong. They probably are behind the curve. You can just look at the reduction in forces and the unemployment. The Fed's in a tough spot because if they reduce things too much, you could get some serious inflation. And with the tariff and the American First policy, they're balancing that. Plus, they're balancing both Republicans and Democrats that are equally aligned in spending money. They may spend it differently, but none of them seem to have any desire not to spend money, right?
Mm-hmm.
And then you have a huge wall of financing that the Treasury has to refinance, and a country that continues to need more and more money to fund its businesses, and we're getting less and less externally financed, right? If all of your deficits are externally financed, that's a good problem, not a bad problem if you're the world currency reserve, right? But when you're the world currency reserve and you gradually internalize all that debt, not as good. And this has been going on for a long time. I mean, I remember in 2002 writing our hedge fund letter saying there was a billboard in LA and it said, "Keep shopping, your economy needs you," right? So this relying on the consumer has been a big thrust in America. Now there's a policy to change that. But why is the Fed independence a concern? Because if the Fed isn't independent, it's breaking down checks and balances. And there has been some discussion about when Fed Powell's term is up in May, who's going to replace him, and is it more of an independent party or is it more a political appointee? And there's also been discussions of would the executive branch, because they want to see rates lower immediately, and they want to see the ability to refinance our debt at a lower rates immediately in replacing Sherman Powell. I don't think they're going to, but there have been discussions about that. So, I think independence is a really good, healthy thing for the Fed. And I also think that we're going to get lower rates, but with lower rates, we're going to get a decline in the dollar, which ultimately has inflationary effects if you buy things overseas or you want to travel overseas.
Okay, well, let's just take this hypothetical then. So Trump, as you stated, wanted lower rates. Specifically, he stated recently he wants a 3-point Fed funds rate reduction. Let's suppose somebody else comes in and replaces Powell. Trump has his way, and we get a Fed funds rate by the order of 300 basis points lower. Okay, what's going to happen to the credit markets in that case?
Well, so first of all, I think President Trump believes the Fed is behind the curve in lowering interest rates to make the economy a looser economy, and that people are suffering at the consumer level, in his belief, because rates are higher than they should be, and then in general, financing costs are higher than they should be.
Mm-hmm.
I don't think he actually would like to see the Fed rates at 300 basis points lower instantaneously. I think our president is prides himself on being an excellent deal maker and negotiator, and speaks and uses his tweeting and his comments as a way of trying to negotiate, right? And sometimes he does in a very narrow way, and sometimes he does in an extreme way. But in answering your question, look, it's not going to happen. So we don't have to worry about the fact that the Fed would instantaneously drop interest rates 300 basis points. And if it happened, it means the U.S. economy, the U.S. dollar, and the U.S. stabilization's in deep trouble, right? The GavCal just recently came out with a piece that said positive real rates are generally a sign of a healthy economy, and negative rates are generally a sign of an unhealthy economy, which everyone knows. And that the real in the world of rates today, when you look at both negative and positive real rates, that our rates today are sort of in balance. They're not really egregiously high, and they actually show a relatively healthy economy. And they're very, very healthy pockets. I mean, it is hard to know today the huge productivity gains we're going to get out of technology that people are forecasting a lot of, like but we're going to get some. So, in answer to your question, look, in some ways, in the short term, every bond market person would be thrilled because even if spreads
Mhm.
blow out, rates dropping 300 basis points, they're still being priced off of a treasury. So they're all going to trade at, if a bond was trading at par today, it's going to trade at par tomorrow at a 300 basis point because they're just going to refinance out the paper at a lower rate. Not
I
going to
want
be
to
good.
pivot.
It won't be good for your direct lending guys.
Yeah. Okay. So we'll chalk that off to science fiction for now because it's not happening. But it's good to kind of theorize. I want to pivot now
Now,
to
the
talk
piece
about
the piece you came up with was the U.S. News report from what date?
that. I was quoting U.S. News. That was from July 10th, so just yesterday. I think it was this week. Trump was talking about, more pressure on the Fed, reducing rates. He thinks they're 3 points behind.
No, I don't necessarily think he thinks they're 300 basis points beyond. I think he thinks he wants rates lower. We have a huge amount of debt that has to get refinanced in the next 24 months. And you have a Secretary of Treasury who would love to refinance it out at the 10-year part of the curve as low as possible. And the 10 years not cooperating because the moment they try to go test that market, the buyers are not going to be that excited. So, and meanwhile, every time they roll short-term debt, it's costing them a lot of money because, quite frankly, the 6-month part of the curve is inverted still.
Okay. You've been in this business for over 3 decades. You've survived several financial crises, 2008, dot-com, COVID, 87. What did these all have in common when it came
I
to...
was around for the flash crash.
Yeah. What were you doing? You remember that day?
I do. I was a student and working in the industry as a part-time employee at the same time, and I was hustling to class.
What was your initial reaction when that happened? Do you remember that?
Intrigued.
Intrigued. You didn't have any money on the line at the time, right? You were still a student.
No, I had no money on the line.
No.
But
Okay.
when '08 happened and I had money on the line, and I from the time I left Lucadia and where I was on my own, I didn't have a negative 12-month period ever until 2008. Um, you know, I the drop wasn't so disturbing, right? You saw other drops, but it was the freezing up of the financial institutions and the economy and the circles of getting money, trying to get a wire out required real effort. And that in of itself was quite scary, but like anything when you're in the trenches, you just focus and move ahead and stay disciplined.
In retrospect, were there signs that the markets telegraphed in regards to '08 that maybe we could have picked up on?
There's always signs that are telegraphed in everything, whether it's '08 or it was '98 or it's the question's always timing. When is getting the timing's tough, but understanding the dynamics is always there. I mean, we can go way off in left field if you want at a whole bunch of different topics, and I can tell you risks that if you're aware of them, then you're aware of them, and then you may not be able to control them, but the risks that occur, and they may never happen, but it's likely to happen.
Okay. Can you maybe help us identify some warning signs now that you're watching? You mentioned a few in the beginning already.
Let's take something that was pretty obvious to us.
Yeah.
It was pretty obvious to us a couple of years ago that rates were going up. And you could say, well, what made that so obvious? Because every central banker in the world wanted rates to go up, and they were signaling they wanted rates to go up. So, yeah, you could have gotten it wrong, but what was the prize in betting against it, right? Why would you bet against the Fed, right? You're better off saying, look, it looks like they're going to go up. I don't know when, but it's being signaled. It's being well signaled. I need to adjust my portfolios and my mentality for an increase in interest rates instead of set it and forget it, right? So now in hindsight, I guess, I didn't know, but I knew that I wanted to get my maturities and duration shorter, and that lending long or investing long wasn't going to be a great idea. And I could have been wrong. But if you're wrong, what's the harm? You just make less money, right? the first key in investing is always to prevent losing money. I don't mean mark to markets. I mean permanent losing money. Next is to avoid a situation where you can't reshuffle because there's an opportunity cost of money. Those are the two most important things. If you do those two things, it'll all sort of work out. The concept of an ultra short duration portfolio, whether it's high yield or it's all investment grade, is that it should have low volatility and provide a spread to a 6-month T-bill or a 1-year treasury or 18-month or 2-year, depending on where the duration is. So, one of the things you could say is, well, I have, Schwab money market fund, and it's snacks, NAX, NAAXX, or NA, I think it's SNAXX. Because I have it in this Schwab money market fund, and it's yielding Y. I think I can go to my Bloomberg and tell you. So the Schwab money market fund, yes, is SNAXX. And I'm just picking it because it's a huge money market fund, and it's a money market fund, right? It's not supposed to break the buck. It's never supposed to have a price higher or lower than the buck. And the implied yield as of yesterday was 4.28%. So if rates don't go up or down and everything stays ceteris paribus, you can sort of expect before fees to make 4.28%. So you could say, okay, well, I can buy that. I can buy a CD at the bank. I can buy, treasuries, or I can buy an ultra short duration fund. Well, the question is, do you want to own snacks, or would you rather get the whole meal by owning an ultra short duration fund? So you could get snacks for a whole meal. And the question is, well, how much is the whole meal? Well, the whole meal is going to get you 50 to 100 basis points net of fees, I think relatively consistently over snacks. But you're going to have a little more volatility. You might have, a breaking of the buck where the NAV that you come in and the NAV to get back to that level might take, depending on the market conditions, anywhere from 0 to 45 or 60 days. So wouldn't be a good instrument if your time horizon is 90 days or less. But if your time horizon is my kid's going to college and I want to put the second half of the tuition money, which is due in January, in something that maybe gets a little more yield, and I'm not worried about that tiny volatility difference, you might want to look at an ultra short duration strategy. And you could say, well, and you pick up significant premium over a money market fund.
If I were to say to you, well, I kind of want higher yield, I would prefer a longer duration bond fund instead. What are the advantages and disadvantages of a shorter duration over a longer one?
So I actually would take I'll answer your question, but I would actually take the reverse, which is, I'd rather take spread risk or credit risk or underwriting risk, which is one of the reasons why high yield can be an attractive asset class, right? Because it's a hybrid between high quality debt and equities, and make my money there, and rather than focus on duration itself. But obviously it's very simple. The longer the maturity, if rates go up, you lose more money than if you have a shorter maturity portfolio. And if rates go down, you'll make a lot more money under a longer maturity portfolio, all things being equal, than a short maturity. And it's simple math. Bond rates go up, prices go down, and the inverse, right? Because if rates went up, well, hell, if you had fresh money, you could go buy at a higher rate, and you've locked in a lower rate for a longer period of time. So that's why the adjustments exist. So with a lower duration portfolio, you have less upside capture and less downside capture than you would relative to interest rates. And then it also works with spread. How much premium am I getting paid over a treasury, which is, quote, a riskless asset? Again, longer duration, if spreads widen, you lose more money. If spreads tighten, you make more money. So those are considerations. I mean, one of the great things about fixed income is, people think, it's not that complicated. You have underwriting risk, you have spread risk, right? You have liquidity risk, you have capital market needs to be open risk, right? You have all these other issues. So, it's got a lot more math. And quite frankly, in return for those coupons, right, you've got limited upside.
Okay. You've also had experience investing in SPACs or working in the SPAC space. Can you just, for the layman watching, explain why there's been this rise of SPACs versus IPOs, especially in the tech space?
Sure. So First of all, SPACs are what they call special purpose acquisition corporations. These are companies that go raise a whole bunch of money to go hunting for an acquisition target for them to acquire. And then as a result of acquiring it, by definition, it's public because the special purpose acquisition corporation already went public. So it's almost like a reverse merger. People are familiar with that phrase. And the sponsors of these SPACs, they're already public. They went through all the efforts of getting registered with the SEC, being public and all that. They have a bunch of cash, and now they're going to go find a company that wants to become public. And in order to raise the money, people don't want to just give them a blind pool and say, here's my money, go freely and buy what you want to buy. I'm going to trust you. They say, I'm going to give you the money. And when you have a deal, I get to decide if I want to participate or not. So whenever a SPAC makes a transaction, each shareholder has the right to say, I'm going to roll my SPAC into the new co or the merged company, or you give me my money back that I lent you. So if I gave you $100 million, you need to give me my $100 million back if I don't like the deal. And there's also a date where if you don't find a deal, I don't want to have my money tied up forever. So typically they have a liquidation date of, call it 2 or 3 years. So the issuer, let's say, I think of it as debt instrument, quite frankly, but the issuer raises $100 million, and the people that give them the $100 million say, great, you have 2 or 3 years to go find a deal. If I don't like the deal, I get my money back. And if I do like the deal, I'll roll into it. Oh, and by the way, the money I gave you, you should put that in a secured account with treasuries or money market funds, because I don't want to worry about you investing it poorly. I want it to be basically defeased. And that income on those treasuries, that should go to us, right? Meaning it builds up as a cushion. We don't get the interest, but it builds up as a cushion so that when you redeem us, we know there's collateral building. So the way to look at it is, you could have, the way we look at it is we look and say, we're always going to redeem. We're never rolling into a deal, ever. And the reason it's called pre-merger SPAC arbitrage. And the reason we don't roll into the deal is it's a different business. That's an equity business. If people really, really love the deal, Donald Trump, is creating Truth Social and they love the deal, thing goes up to $20, $30 a share, I just sell. Let someone else decide. And I made more than the $10 I would have gotten back had I just redeemed or waited to maturity. And if I don't like the deal, I get my principal back. So to me, it's like a convertible bond backed by treasuries.
Is it fair to say that many SPACs are higher risk in nature for the investor, and therefore they would want a risk premium that should drive the deal price lower, which would be less advantageous for the companies involved that want to merge? Is that a fair statement to make?
There's been some very high quality SPACs. Utz, it's a potato chip manufacturer, and it's a high quality company. By and large, there's a lot of crappy companies, but there's a lot of crappy IPOs.
Yeah.
I think the biggest issue with SPACs has been that the sponsors, the guys who put up the money to make it go public and all that kind of stuff, get very, very large economics in the SPAC and are incentivized to do a deal. Obviously, if they did a good deal, it would be better. But they're they're incentivized to a deal, and often they're incentivized to do a deal where if it works out like a home run, that's great, and if it doesn't, okay, no big deal. So they're encouraged to take more risk to get more gearing.
In your experience, have you noticed that SPAC deals have had more fair or less fair valuations placed versus, let's say, an underwriter who's had access to the entire capital markets to price a deal?
I'm not sure your premise of information actually is correct on the performance of SPACs versus new issues. Because in fact, there was a period where SPACs could do forward-looking statements and projections, which you can't do in an IPO, whether they were correct or not, garbage in, garbage out. But I think actually in some ways the theory always in SPACs is that the information they can provide is actually better. I think the problem that SPACs have had, just like some IPOs, is, again, it's the quality of the transaction you're backing into something. For me, the opportunity as a fixed income like security is to be in the arbitrage end of the business where you put the money up, you basically have the right to put the paper back, so you're going to get your money back, and you get a call option if the deal is good, and you and people like it, so the market will clear a higher price, so
Hmm.
you don't have to roll, and that's really the opportunity. They're very short duration, and you will find in general pre-merger SPAC arbitrage as a strategy provides a significant premium to owning a 3, 6, 9, 12-month treasury bill.
Can you just at a high level explain a fund strategy that involves SPACs and basically how you can construct a strategy around that?
I mean, I mean, the guys that there are two. I mean, there's not really been a public fund that survived that just bought SPACs for the exit for the new deals. In fact,
Hmm.
I think there's probably only one pre-merger SPAC arbitrage public vehicle today, meaning it's either a mutual fund or an ETF that survived. There might be two. There might be two. But generally, individuals can go buy SPACs. I mean, all you have to do is look at the price you're buying it at, look at how much value is in trust, right? The trust is worth $10 in value. You're paying $9.75. That means there's a 25% discount, just like you would with a closed-end fund. And the question is, well, if the SPAC is going to liquidate in a year, I'm going to make 25 cents over 975. If they don't announce a deal and they liquidate, and if they announce a deal and I don't like it, I'm going to make 25 cents at that period. And maybe they come out sooner. So instead of a year, I only hold it for 3 or 4 months. So really, it's just present value, future value. You know what the future value is. You know what the present value is. You're uncertain on the time period, right? Whether it's a deal or not a deal. And then you just calculate the IRR and determine, is that a reasonable return to tie up your money in something that trades daily and you can always sell.
Finally, I'd like you to comment on this recent trend of several companies now starting to look into issuing convertible bonds to buy Bitcoin into a treasury. Have you looked into the strategy at all, and do you have any thoughts?
So I don't own any Bitcoin.
Hmm.
Um, and I don't own any crypto. I do believe in blockchain technology.
Sure.
I acknowledge that Bitcoin specifically is a real asset class. It's an asset class. It's a store value of currency, in this case, dollars. Um, Gold is also known as a store value of currency. I don't buy gold. I believe if you want to protect yourself from the end of money, there are other things that I speak to me and are more comfortable for me than gold or Bitcoin. Doesn't mean it's right or wrong. It just that's me. But you have firms out there that like MicroStrategies that are basically have no operating business at all, and they're buying Bitcoin as a store value of currency, and they're using debt instruments to be able to buy more and more and more. So it's like a levered bet if it goes up, and if it doesn't go up, it's a levered bet that it goes down, and live by the sword, die by the sword. So if Bitcoin went down, I guess it's about $110,000 or something like that today. If it went down to $43,000 and it stayed there for a prolonged period of time, MicroStrategy would have a hard time paying off its debt, and it would not be a great store value of currency for the underlying holders. But if it stays at the level it's at today and continues to go up or even drops a little and sustainable, they'll be fine. It's a question of when they borrowed the money, what did they buy the Bitcoin at? So where's their margin of safety? And they're borrowing money at basically 0%, where they're allowing the investors to participate in the upside if Bitcoin goes up. So, you could look at it and say, well, I'm getting Bitcoin upside, but I've got downside protection. I mean, it's sort of like buying Bitcoin and um, and selling puts
Hmm.
to sort of do that. I mean, you just buy Bitcoin and you lever it up yourself if you want.
Yeah, that's an interesting perspective. Very good. Thank you very much, David. Great interview. Where can we learn more from you and your work?
Well, I've said enough stuff here. Maybe I'll get too many correspondence. Uh, and I know
Besides
this.
signing up for your classes at NYU.
And David, I know this is not like your typical interaction with your your interviews. So I appreciate the courtesy and breadth that you gave me to sort of go outside your typical experience. I hope it was fun for you and your listeners. Anyway, to answer your
Absolutely.
question, they can go to CrossingBridge Advisors website, or they can just email if they want at D Sherman, D as in David, D Sherman, SHERMAN at crossingbridge.com, or our executive vice president, head of strategy and marketing, John Connor at crossingbridge.com.
All right, we'll
And I
put links
really
down
appreciate
below.
the time and your patience.
Well, we've got plenty of those here at the David Lim Report. So thank you very much for joining the program. And we'll put the links down below, so make sure to follow David and his firm there. Thank you again, and we'll speak soon. And thank you for watching. Don't forget to like and subscribe.